In our case, we said, for no extra cost, you preferred equity people can choose. So at the 5th year, you'll either get your $100,000 back plus all your 10% every year, or you can double down and convert it to participating equity forever.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, I have Josh McCallen. Josh, how are you doing today?
Great, Todd. This is a great show already. I love it, man. I'm a big fan of yours.
Well, appreciate it, and definitely appreciate you coming on the show to give our listeners a little bit about Josh. Josh is a renowned hospitality expert, a conference speaker, a producer, and podcast host. His unique approach to entrepreneurship, which he terms capital hacking, sets him apart as a true innovator and thought leader in today's business landscape. His genuine other-centeredness and true love of service have made him a remarkably attractive syndication partner for many. As a hospitality executive, innovator, and builder and investor, his transformative, soulful service approach is quickly elevating him to the status of a resort rehab guru. And with that said, Josh, give our listeners a little more about your background, what you're doing today, and why you're so awesome, man. I love it.
Well, Todd, that's humbling. You know what just happened? There was someone else wrote my bio. It was a team, a husband and wife team, Amalia and Dan. Thanks for a great bio there, guys. They've been working with me for a year, and I did not realize we wrote a new bio. So thank you so much for that, both of you guys.
It was good, and obviously they think highly of you, and I think a lot of people do because you were introduced to us by a previous guest, Eric Cabral. Spoke very highly of you, and I've heard a couple other people mention your name. So it's always good.
Dude, Todd, that's a big deal. So I was looking you up, Todd, and I will tell you more about me here in a second, but I was super impressed that you got on Bigger Pockets podcast, 248. What a big deal that is. And I'm really a big admirer of them, Brendan Turner, Josh Dorkin, Dave Green. Get to know them. I've gotten to know them a little bit. Are you in GoBundance with us?
I'm not. I've just was told by one of my investors that I need to join. So we'll see.
You should.
Good news, though. I've got Brandon Turner coming to Minneapolis, April 24th and 25th. I'm hosting a conference, which, by the way, I would love to have you at. But Brandon Turner's coming, so it's really
congratulations, cool. Buddy. See, I knew it. I looked it up. First of all, there's a lot of reasons for us listeners. Okay, we're all in the same boat. All of you Pillars of Wealth listeners and community, like I love being part of now. Thank you for having me. We're impressed by you, Todd, because you're at episode. I think you're in the 200s as well.
Yeah, correct? Yeah. This will be like 250 something probably.
Okay, so I'm like your Bigger Pockets number, right? You were 248. I'm 250 in your world. It's a big deal, guys. If whoever's driving, don't swerve off the road. But Todd hitting the 200 mark and getting to the 300 mark, there's probably like rarefied one single digit people that ever reached that many consistent shows, which, by the way, as an outsider, it tells me that you're a guy that can get things done and stick with it and add value. So an honor to be on your show.
Man. Appreciate it.
We are, real quick. So Amalia and Dan wrote that nice intro, but there is a lot of truth in what they were trying to articulate. We really got into syndication, which I believe you're in as well with apartments. We're like the apartment syndicator that does resorts.
Yeah. So
it's very similar to what you do. I'm friends with a lot of those guys. I'm a part of the Real Estate Guys Network, Real Estate Radio Guys, where we do the secrets of syndication and capital hacking's our podcast, and we bring a bunch of people down to learn how to syndicate efficiently and ethically.
Yeah.
And so I'm like the guy that does it for resorts, and we have a nice team called Accountable Equity. My wife's a part of that. The one thing they left off in the bio is usually the one that makes everybody die laughing, but Melanie and I have been married 22 years. That's not funny, Todd. Okay, that's not funny. That's the real deal. But she and I have been graced with 10 children. And the
Wow.
10th baby is going to be born in a few days. So by the time this airs, we will be holding the 10th baby.
Wow, man. Wow. And your wife probably works full time, right?
She works, well, listen, I don't know if you meant that as a joke or not, because she does work way more than full-time. I know you know that. But she also does work with us in accountable equity. She serves
Really?
as in the
Oh my
president's seat,
gosh.
actually.
That is unreal. What an amazing woman if she can take care of 10 kids and be doing more.
She is
That's
amazing.
amazing.
She's amazing. We do have strategies to get her involved, but she, she's here 2 days a week at the actual properties. But it's more, you know why we did it, Todd, is more, not that we didn't want to put any more burdens on beautiful Melanie, but she adds that feminine voice.
Yeah.
And I've really come to really appreciate the combination of men and women in our company. So
Yeah.
she hasn't worked outside the home in 20 years, but now she works outside the home and in home, of course.
That's good.
But
That's awesome.
no, I mean, I'll answer any question you want. I'm just honored to be here.
So resorts. So you guys are buying resorts. Are they distressed resorts? Take me through kind of what your acquisition.
Sure.
Like, and what are you doing? How are you being profitable on these resorts?
That's a good question. So the big difference, I guess, so the similarities to the world of apartment syndication is that we raise money with a private placement. Good people from all over the country join us. Some use their IRA money. I'm sure you guys talk about that.
Yeah.
Some people use their cash out of their account. And they can start at 50,000. So that's how we buy a resort. But the difference between apartments is apartments have a really interesting model. And I love a few apartment guys. Like, I'm big friends and partner with Matt Faircloth, who's a Bigger Pockets contributor. And he is a fantastic apartment syndicator, I'm sure, as you are. And whereas resorts, we're a big operating company, meaning an apartment, you can usually find a wonderful team locally wherever you buy the asset. And that's a genius, fantastic way to scale your business. We could theoretically do that in resorts, but what we've really been called to do is be the managers. So we're really the heart. I'll show you if you have a camera screen.
Yep.
Vivamee really is the name of the brand that we are managed by. It's our brand. So it's like our tiny baby Hilton. And it has a really heartfelt meaning. And it means, in a stylized French term, it means to revive the soul. So when we look at resorts, we want them affordable. We want to buy them distressed. And what we always say is delayed maintenance is one of our best friends, because it allows us to come in there, buy affordably, just like you would buy a cheap flip house, and imprint a very thoughtful design, not haphazard. Just like when you buy a flip house and somebody put a real tiny addition on and it's ridiculous and it's got 7.5 foot ceilings. You're like, why did they do it that way? Yeah. And you wish they didn't, right? You're like, now I got to fix this. We love buying them where they need everything from roofs and HVAC systems to reconfigurations, because we'll take the money we would have paid them for a retail price and put it into a integrated, thoughtful design. So our skills go through the design features, but at the end of the day, we want to manage them. And that's kind of a strength we have, is we're not trying to buy them and flip them. We're trying to buy them, restore them. So we say revive the soul of the building. And then we want to revive the soul of hospitality. And this is kind of the mission we're on in life. And I'll take a deep breath here so you can catch up. But our real purpose is Vivamee, and that's where we're going to share with you some core values of how we run business, our business and other businesses we've been a part of, and how Vivamee can really, we call it soulful service. And what we do is we treat everyone who walks through the door with infinite dignity and worth. And so this kind of hospitality, sometimes some people call it old-fashioned hospitality, where people treat you right and they love you when you walk in the door. That's what we engender and train, and we're rigorous about training every week on the why we do what we do, we call it. So I've given you a mouthful, but I can also slow down and just give you the simple structure. Buy something. I'll give you an example from the Renault resort we just bought. We bought it for $5 million from a bank. It had at one point been appraised to over $10 million, but because of downturns in the management and a very tired family that ran it, it just fell into the ground. Bank took it over. We bought it from the bank. So we paid either half or less than half of its retail market value. We then spent $10 million upgrading it. So we spent more upgrading it than paying for it.
Wow.
And the reason we did that is it's a 155-year-old resort, winery, golf course, 240 acres, 120,000 square feet. And we wrote a business plan. We captured leads from weddings to fill the property up. You're looking at it in the background. It's absolutely breathtaking. It's really the size of a small town. Like we have we can do 5 weddings at the same time, 5 commercial kitchens, 3 bars, 2 restaurants, hotel. It's a different scale than what you might think. It's quite big. And then a beautiful, really world-class golf course called Vineyard National. So, and not to mention, we've been making
$5 million.
Yep. Yeah, we really, we took a home run here. And to give you an example, Cushman Wakefield appraised it this fall. We've only owned it for just over a year. And the new appraised value is 19.5, just from the work we did and the pipeline of sales.
Yeah.
So that's how we do it. We force appreciation. We force appreciation through fixing the property physically and then selling the heck out of the assets and doing a great job. And by selling it, we create a pipeline of revenue, and that revenue then changes the valuation of the business.
Yeah, I mean, very, very obviously similar approach to multifamily with obviously a different twist to it, right?
Correct.
So when you're doing this, your overall business strategy, is it to keep these properties long term, or are you coming in, doing your work, working your magic, and then exiting out?
So our Vivamee is meant to be a perpetual hold. So what we tell our investors is, I'll give you all kinds of answers about the depth of how we design our PPMs and stuff, but I don't want to overwhelm you. The simple fact is we recapitalize our investors, meaning we give them back their initial investment plus profits, usually within 5 years or less.
Got it.
Through debt refinance.
Yeah.
And then of course we are a mega depreciation asset, right? Yeah. We have so many chairs and spoons. Look, I'm holding up knives, everything from equipment to desks. We have tons of it. So there's really good tax advantages.
Yeah.
Probably some of the best in real estate.
Oh, I'm sure things are depreciated on 5-year scale or maybe even less.
Bonus. Yeah. With bonus right now, it's a very smart tax advantaged way to earn a double-digit return from real estate. And I'm going to throw one last thing that's going to blow your mind, Todd. We are a resort, which means you actually want to come see it when you own it. You know what I mean? So our investors are always welcome here. Of course, they're limited partners. They're not active members of the management, but
they can still come and drink some wine and
exactly.
Cool. That's actually a really good bonus. So when you're looking for these properties, you guys, where are you? Where's your main office located?
Great question. Well, I grew up in Philadelphia.
Yeah.
This property is in New Jersey, about an hour from my personal home. We are about to acquire, we believe, 2 new properties this year. So we'll be raising more capital. One will be outside of Annapolis, Maryland. So a beautiful waterfront, 200-acre resort. And then one will be a more functional convention center up in North Jersey. But we will buy regionally, I think, for the next 2 years. But eventually, Todd, we will be on the path to 100 resorts nationally. Mostly because this may sound cheeky, but our heart isn't so much in the syndication necessarily or in the construction, though we're very strong at both and we love them. Our heart is restoring and reviving hospitality for the guests. So we have this kind of calling where we want to get to 100 beautiful resorts that are delivering this kind of soulful service where you're treated with infinite dignity and it's really tangible. You'd have to, as a matter of fact, Todd, we got to get you out here because you probably know Jay Scott and Matt Faircloth from Bigger Pockets. They're both doing a mastermind here in a few weeks or so. That's actually a cool thing too. When you have a resort, people do masterminds at your resort.
Yeah. Yeah.
How cool is that, Todd?
And you get a free invite probably. Right?
I do.
Come to
I do.
Yeah, that's great. That's great. So I guess I'm not, familiar a ton with your niche of your industry.
Sure.
Obviously, hospitality is a big word, right? You've got the Marriott and you've got the, Hiltons of the world, but those are different. That's not what you're doing. Is there a kind of a, when we look at like multifamily, we've got institutional buyers that are really coming in and have over the last 20 probably years and really consolidated the market a lot. It's the same thing is starting to happen in mobile home parks. Is that a thing in your resorts?
Absolutely. Yeah. Let me give you two examples that you'll know of. Okay. So there's this famous properties, mostly city oriented, but Kimpton. Have you ever heard of Kimpton Hotels and Resorts?
I have not. No.
Okay. So maybe it's an East Coast thing, but Kimpton was one of those pioneers maybe 20 years ago. They started building beautiful, they reclaimed old buildings that were, I don't know if they were even all hotels. Sometimes they were office buildings and they're in the middle of a really cool part of the city. And then they turned them into these posh hotels.
Got it.
Really awesome style. Maybe not everybody's taste, a little more modern, but that grew to 40 units and then sold double. It sold the real estate, went to a REIT, and the brand and the business grew to a public company. So my point is there's ways where as these grow up and become multiples of the same type of brand, like in our case, Vivamee, and we're all managed the same way, there'll be many different ways for massive exits, high multiple exits.
Yeah.
But that's not so much our heart. There's another one that you've heard of. There's another one that we've all heard of that grew from similar to our beginnings, one off resort, then another one, and probably at year 10, the famous properties called Four Seasons Resorts and Hotels you've probably heard of. Mm-hmm. It only took them probably 10 years, and then they had 5, 6, 7. By the time they sold for multiple billions of dollars, they only had 100 resorts in the whole country, the whole world. And they sold to Bill Gates and Prince Ali. So there are ways to have major exits or just roll-ups. Yeah. Or get purchased by a curio collection from Hilton or Marriott autograph collection, and they buy all of them.
Yeah.
So there's various exits. We don't really talk about that much. You're the first person that's ever asked me that. I'm really proud of you. Normally, we just talk about how they're great cash flowing assets for our investors. It's pretty much going to be a buy and hold. If there's this one is partially in an opportunity zone. If you've heard of those, so we did an opportunity zone fund, that means and that means you need to hold it for 10 years to really maximize it. Yeah. So our investors know they're in for at least 10, but they'll have their money back fast. They'll have income forever, and it's a good win-win. We talk about it up front.
When you do this, maybe opportunity zone might have been a little different, but when you do your traditional fund and you're raising and you do that refinance, are the investors staying in long-term, and do they maintain their shares, or how do you trade that?
Great question. So now this shows me that your audience must be pretty knowledgeable, right, Todd? Because we're going in.
I think so. We try to talk about this stuff, so hopefully they're kind of following along, and I think they're pretty dang smart people. So
I believe in that, because the name of the show is Pillars of Wealth. So you don't listen to this show to chuckle, even though I know Todd and I, we like to make you enjoy your time. So the answer on your question was about how do they stay in the deal.
Yeah.
So you know what? You're going to like this, and this is going to get really specific, everybody. So I hope you're holding on to your steering wheel. It's not going to be funny. It's going to be very specific. So when a person does a private placement memorandum, like us, we're the sponsors, you have options to design the investment to fit the investors and the property. You kind of have to do an assessment. You have to say, well, this is going to be a 10-year hold. So first thing we're going to tell our investors is it's not going to be easy for you to get your money out in 2 weeks or 10 days, or it's going to take time. And you're here because you believe in the asset and it's long-term wealth building. So we go through that, and then we design the offering that is meant for that type of investor.
Yeah.
Great for IRA people, by the way. So then with the type of equity we sold, that's your question. We sold limited partnership equity. Now, of course, we're using the word partnership, but it's actually an LLC. So limited interest, where you are my partner and our partner forever. We do not buy you out. And we don't change your equity position either. Okay. You bought in, you stay at that equity position forever. The big secret is, though, we as the sponsors, we get to choose. Do we take equity payments now? Or do we get something called an 80-20 split? Or do we get 10% of the deal, 30% of the deal, 50% of the deal? Here's what we do. We don't take any money from distributions until 100% of the investors' money's back in their hand and their preferred or their preference. So I always say, think of the preference this way, Mr. or Mrs. Investor. If you gave us $100,000 or $50,000, but let's choose 100, it's easier. And we told you we'd pay you 6% on top of your money for as long as we had your money, plus you'd get your money back first, plus you'll be our partner forever. Then here's how we're going to do it. We as the sponsors will not take equity distributions. Like cash flow distributions will all go to the investors. Once you're paid back, we then also have to give you 6% on your money. Then we're partners equal. Then we're equal partners forever. Okay. And as money comes in, we both cut it in half. So the sponsor gets half and the investors get half, but not until the investors have their money back. And at that point, we're all equals in a sense. We all have equity, but none of us have money in the business anymore. And that's how we run our private placement. The other thing which is really special, is we created a C class, or a third type of equity. So if we have sponsor equity that has to be patient, we call it B equity, which is our limited partners forever. And then we created a third type of equity called preferred equity. This is true preferred, old-fashioned preferred equity, where we give you double digits cash on cash right away. 10% is what we give. And then we will buy you out when we've paid you back plus your 10%. Takes us about 5 years as well. Or, now this is where it gets really crazy. I hope everybody's holding on to the steering wheel. We came up with a really cool thing that our securities lawyer designed, and it's called an option. We've all heard the word option before. It means whatever definition you want it to mean. In our case, we said, for no extra cost, you preferred equity people can choose. So at the 5th year, you'll either get your $100,000 back plus all your 10% every year, or you can double down and convert it to participating equity forever. So we give you 5 years to get double-digit returns and keep your eye on us. If you like us and you want to be part of this for the rest of your life, then just commit your capital to be a partner. So again, the option is free and voluntary. The normal offering is normal preferred equity. We're going to pay you back and buy you out. But you, the investor, get the option to stay in. Did I answer the question okay?
Beautifully. That was really cool. And I'm sure there's going to have to be some people that'll need to rewind that, listen to it again. But I would suggest writing it down. Like I wrote all that down. And now I just need to read through it one more time and I've got it.
We don't mean to make it complicated.
No, it's actually not. It's really a pretty simple look. I'm going to give you 6%. And once all your money's back, plus that, then 6%, we're partners. We're partners. We're going to split.
That's right.
And we're going to, up until the day we sell, we're splitting. Once we sell, we split that profit.
Exactly.
And then the other guys are, hey, you're getting 10%, you're getting no upside. But if you want, we'll cut you in later. You can make a decision later down the road. We don't have to worry about it right now.
You said it. You said it better than me. Thank you. But isn't that option cool?
Maybe I should be your sales guy.
You are my sales guy. Join the team, buddy. And that option became important because so we have a lot of investors. Yeah. And resorts are expensive. Yeah. They have massive wealth building potential. They have to be run very well. So we encourage our investment partners to really get to know us, to understand our deep WHY, our why. And if you follow that, you follow our business plan. And then, of course, we have track records of success. This is not our first rodeo. We've built an entire resort business that I exited from that was very lucrative. And so this is the first time we're doing it as a syndication, though.
Got it.
And I'd love, if you feel, I'm going to pause because you probably have a lot of questions, but feel free to ask me the question about the last 2 years of how I learned, how we transitioned into syndication, because we used to do this without syndication. And it was very, it's been a blessing to become a syndicator, really a big blessing.
One of the best things, before we talk about that, is your limited partners or potential limited partners. All they got to do, and this, I'm so jealous about this. All they got to do is come spend a weekend in your resort, and they can determine if they love what your business is all about. I'm so jealous. My potential investors can't go fly down to one of my properties and just spend the week there, like for a week.
It's true.
So
it's a little unfair, right? It's a little unfair
totally
advantage.
Unfair. I'm so jealous of it.
Sorry about that.
Yeah. But yeah, tell me about that transition. So you started out no syndication, which is, by the way, impressive. But then you transitioned into this syndication. First of all, talk about that transition, and then why, and why'd you do it? Why syndication?
Sure. So I'm going to give good people credit for a lot of this. So about, I don't know, my wife and I have been married 22 years. We had this super wonderful privilege of living in Europe for 4 years. That's helped us to really understand the really beautiful aesthetic. We have our own in-house designers and architects. We're not really kidding around here. We're really built a company. So we had this privilege, but when we came home to America 13 years ago now, we had been in Europe so long, 4 years, we had no real business contacts or anything. And we were running like a 700-year-old resort university campus. So it was a resort and a university campus, and we were the operators.
Was that in Europe or was that when you came back?
In Austria. That was in Austria.
Okay.
Outside of the Vienna. So
nice.
We come back and we say, gosh, man, it's the boom. It was still the boom time. Like, you remember before the Depression. And I said, man, my dream, my whole life is to be a land developer, but I don't know anybody in land development. So we clawed our way into land development by becoming a mortgage broker and all these cool things. And we got this privilege to be mentored by a wonderful person who is a very, very high net worth individual. So he took me under the wing when I was young. And the first projects we got to do for him were $5 million house flips. So crazy size house flips.
Wow, yeah.
We're basically selling to famous celebrities and athletes, and we're doing it on the New Jersey coast. So the New Yorkers and the Philadelphians would buy them. And it was eye-opening. It was the crazy heyday. So there were no real contractors left. They were all too damn busy. So we ended up learning not only how land development works legally and everything, but actually how to build. And so we would be there. Think about it. You're in the middle of a multi-million-dollar construction project and your GC is too busy to show up for 3 days. What are you going to do? Stop the project? No, you're going to take over and be the GC. So we became, I think we built personally anywhere between $30 and $50 million, depending on how you count it. And boy, did we learn how to build things. And then the recession happened, and we, 3 years of scrapping and struggling, just like anybody, bought a franchise business, things like that. And when we came back, I'm sorry, I don't want to take you down too many paths here, but I think it was about syndication. So I'll tell you, here's what happened. I came back from the Great Recession. That same wealthy individual, that wealthy family, owned a dilapidated hotel that they were going to tear down, but then the Depression started. So they never tore it down. You get it? So they're sitting on this dump for 5 years that they don't even tell anybody they own. It's so ugly. And he says, what should we do with it? Because it was 2012 now. He said, well, I think the Depression's slowing down. Let's do something with that hotel. So I wrote a business plan to restore it. And the idea would be, let's restore coastal properties up and down the Northeast where there's plenty of money, but ugly buildings. And he said, I love that idea. And then we'll get managers to manage it, and we'll just keep doing it up and down the coast, because he had plenty of money. Well, this first one, I hired a travel channel designer, and we came up with all these cool ideas, and we changed the look to a mid-century modern chic beach house hotel. And it was awesome physically. And it was awful management. We hired a professional management company, and they failed us so bad that the F word was a common word at our front desk, because that's how much people hated us. They loved the way we looked, but that we were awful. They were awful at cleaning. They were awful at getting people in their rooms on time. They were awful everywhere because some other time I'll explain. No hard feelings.
Yeah,
it was hard.
but look, when you go to a resort, I don't care how beautiful it is. You still want a clean room. You still want good service. You're not going to go back if you don't get the same.
Trust me, you guys, we've all been to one of those resorts that's either at the top of a mountain. It's like maybe it's a ski in, ski out, or maybe it's a beachfront in the Northeast. Those properties are the hardest to run because they're only busy for a few months, and then they're super quiet for the rest of the year. So what ends up happening to those managers is they don't get staff that they can hold on to because they lay everybody off in a few months. So it is brutally the hardest type of management. So that's where we cut our teeth, built our own management company, and grew I think we had, when I left, we had three highly profitable properties. The valuation from the first one was $8 million. After investments, we had 3. We refinanced. We got it to $100 million valuation in 5 years. Wow. And that's the type of wealth building I'm talking about. Well, here's what happened. That was all a wonderful family's wealth. I was a small piece of that. So my point is, we didn't need syndication. We didn't even know it existed. We always thought the only way to buy a resort is to be very, very wealthy.
You're very wealthy.
Or be Marriott. But we didn't see any way in between until syndication.
Yeah. And so syndication, then when you branched out on your own, that was the result. Got it.
That was the right option. And, you know, people like Bigger Pockets. I don't know if I had heard of that show at the time. That wasn't they didn't talk much about capital raising. So we were introduced by some good friends to the Real Estate Guys Radio podcast. And that group really is very, very good at teaching ethical fundraising. So that's where we learned it.
Awesome.
Changed our life.
Oh man, we could keep on going. We're going to have you back on. I love this topic and very interesting. So, but I want to wrap up with a couple last questions.
Amen.
For you. So let's talk. One thing I want to know, maybe give me three things that you feel like your company does to continue to be successful. So what are 3 key factors that my listeners can take from you and implement into their own business to be successful?
So we'll use our company, the syndication company, which is called Accountable Equity, 2 words, Accountable Equity. You know, it's always fun when people say, give me 3 things. So I probably have 3. So I'm going to share with them in stream of thought here. Number 1, accountable equity. This is maybe good for anybody who's ever going to start a company. What's your why? And if you can, put the why into the name of the brand. This has been a very strategic thing I've done with 3 companies. All have been very, very successful. So what is your why? And put it into the actual name of the business. And the reason I say that is because from then on, it's you're being held accountable by your own brand name. And you're telecasting or projecting to everyone why you do what you do. And fundraising for us is all about being accountable. And raising money from wonderful, good families all over the country means we're accountable to people that aren't independently wealthy and ultra wealthy. So accountable equity is a good example of how we name our businesses so that we keep our why in front of us. Number two is, and this may or may not be normal advice, but we're very big believers of moving from solo entrepreneurship to true corporate entrepreneurship. And I don't know if that's the right word. Corporate might sound negative. I don't mean negative. I mean a team of operators. And this is a big, important step. People that have syndications have the privilege of a different size of scale. So the family that's going to raise money from Uncle Jimmy and go buy a first house flip, husband and wife who borrowed the money are the only operators. Maybe it's just husband, maybe it's just wife. And they have to buy the house, figure out how to fix it, rent it out, get a debt. They have to do everything. Chances are they're good at 1 or 2 of those 4 things, maybe not all 4. And it's pretty risky, ironically. But if you join a syndication that's run by a team that believes in structured discipline, and accountability, it's actually a little safer. So the same $100,000 that could have bought the flip house, yes, you're in charge of your destiny, and yes, you're wonderful at it because you may have those gifts. God bless you. 9 out of 10 people probably don't have all those gifts, and that's where syndication comes in. So we believe in having strong operators. Okay, that's number 2. And anybody that can put operators into their life, even though you're going to have to pay them or you're going to have to share the equity, I think it makes your investment safer, and it gives you the ability to scale. Yeah. The last thing I would say is, and this is my favorite thing about business, can you, and this goes to anybody, can you add hospitality to your business? So I'm in the privilege of, I'm in bars, restaurants, wineries, golf courses. It's clearly hospitality, hotels. But when we created the company that raises money, Accountable Equity, we actually, this is a really big epiphany, and feel free to use this idea. This is great for you and your business. We created a quarterly mastermind for our investors. Okay. And what we do is we show them hospitality. I call it investor hospitality. And we get together, we bring a speaker in regionally, and we talk about the deal that they're in. We talk about deals that we're looking at, and we get to know them. So if you can add hospitality to your type of business model, but do it for the purpose, obviously you're in business to earn a living, no doubt about it, full disclosure, but you do need to have the others focused nature of it. You do need to seek the good of the other. And that can be really beautiful, that type of hospitality in anybody's business. Your business could be at a restaurant. You have a wonderful meal for them. You get to know the families that invest.
Yeah. Yeah. No, that's actually really cool. Those of you who are in the syndication business, I mean, quarterly, yearly, whatever you want to do is just getting together with your investors and sharing what you're doing. And that face-to-face is so powerful, so powerful. I tell people all the time, when they ask me, how do I grow my investor list? And I say, look, you can grow your investor list to 1,000 people, but if you haven't met them, the majority of those 1,000 people are just not going to invest.
That's a good point.
You have to meet them. And face-to-face is so important. So if you can do that, I mean, that's huge. I'm going to implement that into my business right now. So thank you for that, by the way. Okay. So what's a favorite book?
So we've had the privilege on our podcast, Capital Hacking, to have Robert Kiyosaki on the show. And clearly Rich Dad, Poor Dad shocks you if you read it 20 years after you've read it. So I'll definitely put Robert Kiyosaki's book up there. The second and third time you read it, sometimes you realize at first I thought it was simple points, but really there's some profound stuff in there. Like, like the one whole thing about the rich don't work to earn, they work to learn. That'll mess you up if you start thinking about it. That's really good stuff.
Yeah. I'm reading it to my daughter right now.
But by the way, you're right. Kids can actually get into it because it's an easy story. You're right.
She loves it.
But I will tell you the most important book. So that book's cool. The most important book for me that changed our life and really has set me on this course has been Dale Carnegie, which is How to Win Friends and Influence People. And, it's funny. I personally hate the title of that book, so I tend not to use the title. I always say, if you've read it, sounds like you've read it before, Todd.
Oh, yeah.
I'm working on this. I'm wondering if someday I'll write a book this title, but I think the title in modern English, because that was written 100 years ago, in modern English would have been Live for Others and Lead. Because if you really read his book, all he talks about is you must do everything to influence someone. You must be seeking their good.
I did not read that book for a long time because the title turned me off. I did not want to learn how to win friends and influence people. It sounded so negative and kind of derogatory. Like, I don't want to learn how to win friends. I want to learn how to create friendships that are meaningful. But when you read the book, that's not at all what it's like. It's not about winning friends. Right?
I know it, but you know what you and I have to chalk it up to? It was like 1920s when he's writing it.
Yeah.
And those are like the first era of self-help books. He's one of the first ever.
Yeah.
So he's just pulling out names that make sense to him. And you know what? there's a lot of people that are different than you and I that actually think it's a great title. I'm like, you serious?
Yeah.
Anyway, but you and I seem to be cut from the same cloth. It irks me every time I have to say it.
I know. Like I said, I literally would see that title. People tell me about it. I'm like, I don't want to read that book. It's terrible.
It's good, guys. Everybody who's listening, maybe grab the Audible.
Yeah.
The kids like it too, by the way. When you have kids in the car, sometimes you can pop that on and they actually like it. There's reasons. I'll tell you some other time.
Yeah, for sure. So last question, we got to wrap up. What are your 3 pillars of wealth creation?
I don't know. I mean, assets. Number 1 is buy assets. Number 2, I guess, is to not be greedy. And that's what syndication has trained me on. It's okay to share the upside and benefit everybody, because you're ultimately all working towards your own personal family goals. You don't have to have a zero sum and take it all.
Yeah.
And I don't know if there's a third. Those are the 2 that come to my heart right away. I mean, education, man. I'm voracious.
We'll put that down. We got to have
education,
3.
baby. I know, because it's nicer to have 3. It's nicer.
We can't just have 2 pillars holding it up. The middle's going to.
That's a good point. It'll fall down. Thank you.
Yeah. Awesome. Well, this has been awesome, Josh. Really appreciate you joining us on the show. How can our listeners get in touch with you, learn more about your businesses and what you do?
Well, everybody, like you said, is welcome to stay at our resort. Hopefully we'll have a few more before too long. But in the meantime, the best thing is we're on social media. We have a podcast, Capital Hacking. You and I are going to do a show together. Capital Hacking. We teach you to see the code of how money works and realize you can be part of it. And then honestly, Accountable Equity. Come visit. We have an event in the next month or so where you can actually come and meet the other investors. Even you could come, Todd. We'd love to have you be a keynote this year. We'll talk about that some other time.
Accountable Equity. Is it accountableequity.com? How do they get there?
Yes, that's it. Accountableequity.com. Really cool. You have to spell it all the way out, though.
Perfect. Well, put that on the show notes. Link the podcast, accountableequity.com, that people can reach out to you, and then they can get in touch on social media. So awesome, Josh.
By the way, thank you. Thank you for all the good people listening too, because it's important that Todd, we appreciate guys like you that are putting this kind of education out there. It's good for our families to have a path forward for financial freedom and pillars of wealth so they can do better for their family. Thank you.
100%. Awesome. Well, you have a fantastic rest of the day.
Thanks, buddy.
A special thanks to Josh McCallen. I appreciate him joining us on the show. A couple things I took from this episode. First of all, he talks about not having greed, right? And it's so easy to think about the profits, think about how much money we're going to make instead of the difference that we can make, instead of the impact that we can make, instead of making it just everything better for the people that we're trying to influence. So think about that first. Don't think about the money. The next thing he talked about is focus on moving to a team of operators and with structured discipline. And then the last thing that he talked about is just knowing your business why, understanding your business why, what you're trying to achieve, what you're trying to do. And he also mentioned, just trying to put that in your actual name, if you can put that into the name of your company. So just understanding that. So again, appreciate Josh joining us on the show. A ton of value and a really fun interview, just different business model than most people are running, and just a lot of fun to hear him talk about it, and obviously the passion he has about it. So again, thanks a lot, Josh, for joining us, and you have a fantastic rest of the day. Make every day a Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to VentureD.com. venturedproperties.com, venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.